Question 1. To address the challenge of managing foreign exchange risk for a multinational corporation with diverse international operations, which of the following best represents a holistic and compliant best practice approach? Option A. Implementing a dynamic hedging strategy that continuously monitors currency exposures across all business units, aligns hedging activities with the company's overall strategic objectives and risk appetite, and ensures compliance with all relevant financial regulations and disclosure requirements. Option B. Establishing a standardized, fixed percentage hedging policy for all foreign currency transactions, regardless of the specific business unit, transaction type, or prevailing market volatility. Option C. Adopting a passive approach by allowing natural currency fluctuations to impact the company's financial results, with no active hedging or risk mitigation strategies in place. Option D. Engaging in speculative currency trading to profit from anticipated market movements, with the primary goal of generating additional revenue streams independent of underlying business operations. Correct answer is A. Implementing a dynamic hedging strategy that continuously monitors currency exposures across all business units, aligns hedging activities with the company's overall strategic objectives and risk appetite, and ensures compliance with all relevant financial regulations and disclosure requirements. Explanation. This scenario is professionally challenging because managing foreign exchange risk for a multinational corporation involves navigating complex economic environments, diverse regulatory landscapes, and significant financial implications. The need for a holistic approach stems from the interconnectedness of currency fluctuations with operational costs, revenue streams, and overall financial stability. Careful judgment is required to balance risk mitigation strategies with business objectives, ensuring that hedging activities do not unduly restrict operational flexibility or become overly speculative. The correct approach involves a comprehensive, integrated strategy that aligns FX risk management with the company's overall business strategy and risk appetite. This includes regular assessment of exposures across all business units, understanding the drivers of currency volatility, and employing a range of hedging instruments tailored to specific risks and durations. Regulatory compliance is paramount, ensuring that all hedging activities adhere to relevant financial regulations, such as those governing derivatives and capital markets, and that disclosures are transparent and accurate. Ethically, this approach prioritizes the long-term financial health of the company and its stakeholders by avoiding excessive risk-taking and maintaining robust internal controls. An incorrect approach that relies solely on speculative trading, without a clear strategic link to underlying business exposures, is professionally unacceptable. This fails to meet regulatory expectations for prudent risk management and can lead to significant financial losses that are not offset by operational benefits. Such a strategy often lacks the necessary oversight and can be viewed as gambling rather than risk mitigation, potentially violating ethical duties to protect company assets. Another incorrect approach is to ignore FX risk entirely, assuming that market forces will naturally balance out. This demonstrates a failure to holistically assess risk and a disregard for the potential impact of currency movements on profitability and competitiveness. It is a dereliction of professional duty to not proactively manage identifiable risks, and it exposes the company to unforeseen losses that could have been mitigated through appropriate hedging or operational adjustments. This approach is not only professionally negligent, but also likely contravenes regulatory requirements for sound financial management. A third incorrect approach is to implement a rigid, one-size-fits-all hedging policy that does not adapt to changing market conditions or specific business unit needs. While standardization can offer efficiency, it can also lead to suboptimal outcomes, either by overhedging in some areas or underhedging in others. This lack of flexibility can result in unnecessary costs or exposure to significant unmitigated risk, failing to achieve the balanced and strategic management expected by regulators and stakeholders. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying all potential FX exposures across the organization, quantifying their potential impact, and understanding the underlying business drivers. Next, the company's risk appetite and strategic objectives must be clearly defined to guide the selection of appropriate risk management strategies. This involves evaluating a spectrum of hedging instruments and techniques, considering their cost, effectiveness, and alignment with business needs. Continuous monitoring, regular review of hedging effectiveness, and adaptation of strategies based on evolving market conditions and business performance are crucial. Transparency in reporting and adherence to all applicable regulatory requirements, including those related to derivatives and financial reporting, are non-negotiable. Question 2. Analysis of a long-standing commercial client's insurance renewal reveals a significant increase in their operational complexity and a history of minor, but frequent, claims over the past year. The client expresses concern about a substantial premium increase and requests a solution that keeps costs down, hinting that they are considering other insurers if the renewal terms are not favorable. What is the most appropriate approach for the insurance professional to take? Option A. Postpone a detailed risk assessment until after the renewal date, assuring the client that adjustments can be made later. Option B. Agree to maintain the previous year's premium to retain the client, despite the identified increase in operational complexity and claim frequency. Option C. Conduct a comprehensive review of the client's updated operational risks and claim history. Explain the factors driving the premium increase and explore options for risk mitigation or adjusted coverage that accurately reflects the assessed risk. Option D. Offer a significantly reduced coverage package at a lower premium without fully re-evaluating the underlying risks. The correct answer is C. Conduct a comprehensive review of the client's updated operational risks and claim history, explain the factors driving the premium increase, and explore options for risk mitigation or adjusted coverage that accurately reflects the assessed risk. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance professional to balance the immediate needs of a client with the long-term financial stability of the insurer, all while adhering to regulatory requirements designed to protect policyholders. The pressure to retain business can lead to overlooking critical risk factors, creating a conflict between client satisfaction and sound underwriting principles. Careful judgment is required to ensure that any proposed solution is both compliant and sustainable. Correct approach analysis. The correct approach involves a thorough, holistic assessment of the client's risk profile, considering all relevant factors and their potential impact on future claims. This aligns with the core principles of risk management and the regulatory imperative to underwrite policies responsibly. Specifically, it requires gathering comprehensive information, analyzing the interconnectedness of various risk elements, and applying appropriate underwriting standards to determine a fair premium and policy terms. This approach ensures that the insurer is adequately compensated for the risk undertaken, thereby protecting its financial solvency and its ability to meet future claims for all policyholders, as mandated by regulations that emphasize fair treatment and financial soundness of insurers. Incorrect approaches analysis. One incorrect approach involves prioritizing client retention by downplaying or ignoring identified risk factors. This is ethically problematic as it misrepresents the true risk to the insurer and could lead to inadequate pricing, potentially causing financial strain on the insurer and ultimately impacting other policyholders. It also violates regulatory principles of accurate risk assessment and fair dealing. Another incorrect approach is to offer a policy with significantly reduced coverage to accommodate the client's budget without a corresponding reduction in premium that accurately reflects the diminished risk. This creates a false sense of security for the client, while exposing the insurer to potential underpricing and claims that may exceed the reduced coverage limits, again contravening sound underwriting and regulatory oversight. A third incorrect approach is to defer the risk assessment to a later date or to another department without immediate action. This demonstrates a lack of proactive risk management and can lead to policies being issued on an unsound basis, creating future problems for both the client and the insurer. It fails to meet the immediate responsibility of proper risk assessment at the point of sale and can be seen as a dereliction of professional duty. Professional reasoning. Professionals should adopt a systematic risk assessment process that begins with understanding the client's operations and potential exposures. This involves active listening, asking probing questions, and utilizing available data. When risks are identified, the professional should clearly communicate these to the client, explaining the implications for coverage and premium. The decision-making process should then involve exploring various risk mitigation strategies or alternative coverage options that accurately reflect the assessed risk, always within the insurer's underwriting guidelines and regulatory framework. If a client's risk profile is uninsurable or requires terms outside the insurer's appetite, the professional should clearly explain this and, where appropriate, suggest alternative solutions or refer the client to other markets. Question 3. The investigation demonstrates that the firm's initial understanding of business continuity planning, BCP, was limited to the immediate restoration of IT systems following a technical outage. Considering the regulatory framework for the Holistically Assessing Risk exam, ARM 401, which of the following best defines the scope and purpose of BCP? Option A. A set of ad hoc procedures developed and implemented only when a specific disruptive event is imminent or has occurred. Option B. An internal document outlining the firm's IT recovery capabilities with no requirement for external stakeholder consideration or regulatory reporting. Option C. The immediate restoration of IT systems and infrastructure to their pre-disruption operational state. Option D. A comprehensive framework designed to ensure the continuation of critical business functions during and after a disruptive event, encompassing prevention, preparedness, response, and recovery. The correct answer is D. A comprehensive framework designed to ensure the continuation of critical business functions during and after a disruptive event, encompassing prevention, preparedness, response, and recovery. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of regulatory expectations regarding business continuity planning, BCP, in the context of a specific operational disruption. The challenge lies in accurately defining BCP not just as a reactive measure, but as a proactive, integrated component of risk management, aligning with the holistic approach emphasized in the ARM 401 curriculum. The firm's initial interpretation is too narrow, focusing solely on immediate recovery rather than the broader scope of resilience. The correct approach is to define BCP as a comprehensive framework designed to ensure the continuation of critical business functions during and after a disruptive event, encompassing prevention, preparedness, response, and recovery. This aligns with regulatory expectations that BCP should be a robust, documented, and tested process that addresses a wide range of potential disruptions, not just immediate IT failures. Regulatory guidance typically mandates that firms have plans in place to maintain essential services, protect data, and resume operations within acceptable timeframes, which inherently requires a broader definition than simply restoring systems. This approach is ethically sound, as it prioritizes client protection and market integrity by ensuring operational stability. An incorrect approach is to define BCP solely as the immediate restoration of IT systems after a failure. This fails to acknowledge the full spectrum of potential disruptions, e.g., natural disasters, pandemics, supply chain issues, and the need for plans beyond technical recovery, such as communication protocols, personnel safety, and alternative operational sites. This narrow definition could lead to regulatory breaches by not adequately addressing the firm's overall resilience and ability to meet its obligations during a crisis. Another incorrect approach is to define BCP as a set of ad hoc procedures developed only when a disruption occurs. This is fundamentally contrary to the proactive nature of BCP. Regulations require documented, tested, and regularly reviewed plans. Relying on ad hoc measures is a recipe for operational failure, increased financial losses, reputational damage, and significant regulatory sanctions due to a lack of preparedness and due diligence. A final incorrect approach is to define BCP as a purely internal document with no consideration for external stakeholders or regulatory reporting. While BCP is an internal process, its effectiveness and compliance are often subject to regulatory scrutiny. Furthermore, effective BCP often involves communication and coordination with external parties, such as regulators, clients, and critical suppliers. Ignoring this external dimension can lead to misaligned expectations and operational breakdowns during a crisis. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory framework and its specific requirements for BCP. This involves identifying critical business functions, assessing potential threats and vulnerabilities, developing comprehensive plans that cover prevention, preparedness, response, and recovery, and establishing robust testing and review mechanisms. The framework should also consider the firm's risk appetite and the potential impact of disruptions on clients and the market. Question 4. During the evaluation of a financial institution's operational risk exposure, a risk analyst utilizes a Monte Carlo simulation to model potential losses arising from various cyber attack scenarios. The simulation generates a wide distribution of possible loss amounts. Which of the following represents the most appropriate use of these simulation outputs for informing the institution's risk management strategy? Option A. Disregarding simulation results that indicate a higher potential for losses than initially anticipated by senior management. Option B. Using the median loss value from the simulation to set the operational risk capital requirement. Option C. Presenting the average loss value from the simulation as a definitive prediction of future cyber attack losses. Option D. Incorporating the full range of simulated loss outcomes, including extreme but plausible scenarios, to stress test existing cybersecurity controls and inform the development of enhanced mitigation strategies and contingency plans. Correct answer is B. Using the median loss value from the simulation to set the operational risk capital requirement. Explanation. This scenario is professionally challenging because it requires the risk analyst to move beyond a superficial understanding of Monte Carlo simulation and apply its principles to a complex, real-world risk assessment within the specific regulatory context of the Holistically Assessing Risk exam, ARM 401. The challenge lies in discerning the most appropriate application of the simulation's outputs for informing strategic decisions, rather than simply executing the simulation itself. Careful judgment is required to ensure the simulation's results are interpreted and utilized in a manner that aligns with regulatory expectations for robust risk management. The correct approach involves using the Monte Carlo simulation to generate a range of potential outcomes and their probabilities, which then informs the development of contingency plans and the assessment of the adequacy of existing risk mitigation strategies. This is the best professional practice because it directly addresses the core purpose of risk assessment, to understand potential future states and prepare for them. Regulatory frameworks, such as those implied by the ARM 401 exam, emphasize proactive risk management and the need for evidence-based decision-making. By using the simulation's probabilistic outputs to stress test strategies and identify potential shortfalls, the analyst demonstrates a holistic understanding of risk and its potential impact, fulfilling the exam's objective. This approach ensures that decisions are grounded in a comprehensive analysis of uncertainty, rather than relying on single-point estimates or qualitative assessments alone. An incorrect approach would be to solely focus on the average outcome of the simulation as the definitive prediction of future performance. This fails to acknowledge the inherent uncertainty that Monte Carlo simulation is designed to explore. Regulatory expectations for holistic risk assessment demand consideration of the entire distribution of potential outcomes, including extreme but plausible events. Relying only on the average outcome could lead to underestimation of potential losses or overestimation of potential gains, resulting in inadequate risk mitigation and potentially noncompliance with prudential standards that require consideration of a range of scenarios. Another incorrect approach is to dismiss the simulation's results if they do not align with pre-existing assumptions or desired outcomes. This demonstrates a bias that undermines the objectivity of the risk assessment process. The purpose of simulation is to challenge assumptions and reveal potential blind spots. Ignoring or manipulating results that are unfavorable, even if statistically valid, is ethically questionable and professionally unsound, as it compromises the integrity of the risk management framework and could lead to regulatory sanctions. A further incorrect approach involves presenting the simulation's outputs as absolute certainties rather than probabilistic estimates. Monte Carlo simulation, by its nature, deals with uncertainty and provides a range of possibilities. Presenting these as definitive predictions misrepresents the methodology and can lead to flawed decision-making based on a false sense of precision. This lack of transparency regarding the probabilistic nature of the results is a failure in professional communication and can mislead stakeholders, potentially violating principles of due diligence and accurate reporting. The professional decision-making process for similar situations should involve 1. Clearly defining the risk assessment objectives and the specific questions the Monte Carlo simulation is intended to answer. 2. Selecting appropriate input variables and probability distributions based on available data and expert judgment. 3. executing the simulation and thoroughly analyzing the resulting distribution of outcomes, paying close attention to measures of central tendency, dispersion, and tail risk. 4. Interpreting the simulation results in the context of the organization's risk appetite and strategic goals. 5. Using the insights gained to inform the development or refinement of risk mitigation strategies, contingency plans, and capital allocation decisions. 6. Communicating the findings, including the inherent uncertainties and limitations of the simulation, to relevant stakeholders in a clear and transparent manner. Question 5. The monitoring system demonstrates a significant increase in the frequency of alerts related to the primary customer database server, indicating potential performance degradation and an elevated risk of system failure. The current business continuity plan, BCP, relies on a single, established recovery strategy for this database, which has not been comprehensively reviewed or tested in over 3 years. Given this information, which of the following actions best reflects a proactive and compliant approach to managing this risk within the BCP framework? Option A. Focus solely on addressing the technical root cause of the monitoring system's alerts to restore normal performance without revisiting the BCP or its recovery strategies. Option B. Acknowledge the alerts but defer any action until a critical system failure occurs, at which point the existing recovery strategy will be invoked. Option C. Immediately implement a new, state-of-the-art disaster recovery solution for the customer database without further analysis, assuming it will inherently provide superior protection. Option D. Initiate an immediate update of the business impact analysis, BIA, for the customer database, reevaluate the existing recovery strategy's adequacy and explore alternative or enhanced recovery options, and schedule a full test of the revised recovery procedures. Correct answer is D. Initiate an immediate update of the business impact analysis, BIA, for the customer database, reevaluate the existing recovery strategy's adequacy and explore alternative or enhanced recovery options, and schedule a full test of the revised recovery procedures. Explanation. This scenario presents a professional challenge because it requires a firm to balance the immediate need for operational continuity with the long-term strategic imperative of maintaining robust business continuity planning, BCP. The firm's reliance on a single, outdated recovery strategy for a critical system, despite evidence of increasing system vulnerabilities, indicates a potential gap in its BCP maintenance and testing protocols. This situation demands careful judgment to ensure compliance with regulatory expectations for BCP and to safeguard against significant financial and reputational damage. The correct approach involves a proactive and comprehensive review of the existing BCP, specifically focusing on the identified critical system. This includes reevaluating the recovery strategy to ensure its continued adequacy and effectiveness, especially in light of evolving threats and technological advancements. It necessitates a thorough business impact analysis, BIA update to confirm the criticality of the system and its dependencies, followed by the development or refinement of recovery strategies that offer sufficient resilience and redundancy. Crucially, this updated strategy must then be rigorously tested to validate its functionality and the organization's ability to execute it. This aligns with regulatory frameworks that mandate regular review, testing, and maintenance of BCPs to ensure they remain fit for purpose and can effectively mitigate disruptions. The ethical obligation is to protect client assets and maintain service delivery, which is compromised by a demonstrably weak BCP. An incorrect approach would be to dismiss the monitoring system's alert as a minor anomaly and continue with the existing, outdated recovery strategy without further investigation. This fails to acknowledge the potential for a significant disruption and neglects the regulatory requirement for BCPs to be current and effective. It represents a failure to exercise due diligence and a disregard for the potential impact on clients and the firm's stability. Another incorrect approach would be to immediately implement a costly, untested, and potentially overly complex new recovery strategy without a proper BIA update or a clear understanding of the system's current criticality and dependencies. This demonstrates a lack of systematic BCP development and could lead to inefficient resource allocation and the creation of new vulnerabilities. It bypasses essential steps in the BCP lifecycle, undermining the holistic assessment of risk. Finally, an incorrect approach would be to focus solely on the technical aspects of the monitoring system's alert without considering the broader implications for the BCP. This narrow focus overlooks the need to integrate BCP considerations into the overall risk management framework, and to ensure that BCP testing and maintenance are aligned with business objectives and regulatory expectations. The professional reasoning process for similar situations should involve a structured approach. First, acknowledge and investigate any alerts or indicators of potential BCP weaknesses. Second, conduct a thorough BIA to confirm the impact of a disruption. Third, evaluate and select appropriate recovery strategies based on the BIA and risk appetite. Fourth, develop comprehensive BCP documentation. Fifth, rigorously test the plan to identify and rectify any deficiencies. And sixth, establish a regular maintenance schedule for ongoing review and updates. This iterative process ensures that the BCP remains a dynamic and effective tool for managing operational risk. Question 6. The performance metrics show that the firm's 10-day value at risk (VaR) has been steadily increasing over the past quarter, approaching the upper limit of the risk appetite framework, although it has not yet breached any absolute regulatory capital thresholds. What is the most appropriate course of action for the Chief Risk Officer? Option A. Initiate a comprehensive review of the trading strategies, underlying risk factor sensitivities, and the VaR model assumptions to understand the drivers of the increase and assess the need for adjustments to hedging or portfolio composition. Option B. Focus solely on the absolute VaR number and request a marginal increase in the risk appetite limit to accommodate the current market conditions. Option C. Monitor the situation closely for another month, assuming the increase is a temporary market fluctuation, and only take action if the VaR breaches the absolute regulatory capital thresholds. Option D. Advise the board to immediately reduce the firm's overall trading volume by 20% to ensure the VaR remains well within the risk appetite limits. The correct answer is A. Initiate a comprehensive review of the trading strategies, underlying risk factor sensitivities, and the VaR model assumptions to understand the drivers of the increase and assess the need for adjustments to hedging or portfolio composition. Explanation. This scenario is professionally challenging because it requires the risk manager to interpret a key risk metric, value at risk, VaR, and translate its implications into actionable strategic decisions within the constraints of regulatory expectations. The challenge lies in moving beyond a purely quantitative understanding of VaR to a qualitative assessment of its impact on the firm's overall risk appetite and capital adequacy, particularly when faced with potentially conflicting internal pressures or interpretations. The correct approach involves understanding that VaR is a point-in-time estimate of potential loss, and that deviations from expected VaR, especially sustained breaches, signal a need for a deeper investigation into the underlying assumptions, market conditions, and trading strategies. This approach aligns with regulatory expectations that firms not only calculate risk metrics, but also actively manage and respond to the information they provide. Specifically, regulators expect firms to have robust risk management frameworks that include monitoring risk limits, investigating breaches, and taking corrective actions. A sustained increase in VaR, even if within a broad tolerance, suggests that the firm's risk profile may be evolving, potentially requiring adjustments to hedging strategies, capital allocation, or even business activities to remain aligned with the firm's stated risk appetite and regulatory capital requirements. This proactive and investigative stance is crucial for maintaining financial stability and protecting stakeholders. An incorrect approach would be to dismiss the increasing VaR as a statistical anomaly or a temporary market fluctuation without further investigation. This fails to acknowledge the potential for systemic issues or a gradual drift in risk-taking behavior. Regulators would view this as a failure to adequately monitor and manage risk, potentially leading to undercapitalization or unexpected losses. Another incorrect approach would be to immediately advocate for a significant reduction in trading activity solely based on the VaR increase, without a thorough analysis of the drivers behind the increase. This could lead to missed profitable opportunities and an overly conservative risk posture, which, while not directly a regulatory breach, might not be the most effective risk management strategy if the VaR increase is driven by factors that can be managed through other means. A third incorrect approach would be to focus solely on the absolute VaR number without considering its context relative to the firm's risk appetite, capital levels, and the prevailing market environment. This narrow focus can lead to misinterpretations and inappropriate decision-making. Professionals should employ a decision-making framework that begins with understanding the firm's risk appetite statement and regulatory capital requirements. When a key risk metric like VaR shows a concerning trend, the framework should involve 1. Investigating the drivers of the change in VaR, e.g., market volatility, portfolio composition, model assumptions. 2. Assessing the implications of the change in VaR against the firm's risk appetite and capital buffers. 3. Evaluating potential responses, ranging from minor adjustments to significant strategic shifts. 4. Documenting the analysis and the rationale for any decisions made. This systematic process ensures that risk management decisions are informed, proportionate, and aligned with both internal objectives and external regulatory obligations. Question 7. Comparative studies suggest that a well-defined communication plan is crucial for effective risk management. Considering the principles of process optimization in risk communication, which of the following approaches best aligns with best practices for a financial services firm operating under UK regulatory frameworks? Option A. Disseminating all identified risk information to every stakeholder group simultaneously as soon as it is identified. Option B. Relying on informal ad hoc communication channels to inform stakeholders about emerging risks as they arise. Option C. Prioritizing communication of risks solely to internal management teams with minimal external disclosure. Option D. Developing a comprehensive, multi-channel communication strategy that segments stakeholders, tailors messaging, and establishes clear protocols for dissemination and feedback. The correct answer is D. Developing a comprehensive, multi-channel communication strategy that segments stakeholders, tailors messaging, and establishes clear protocols for dissemination and feedback. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for timely and accurate risk communication with the potential for information overload or misinterpretation by diverse stakeholders. The firm's reputation, client trust, and regulatory compliance hinge on the effectiveness of its communication strategy. A failure to plan can lead to reactive, inconsistent, and ultimately ineffective communication, potentially exacerbating the impact of identified risks. Careful judgment is required to tailor messages to different audiences, select appropriate channels, and ensure clarity and conciseness. Correct approach analysis. The correct approach involves developing a proactive, multi-channel communication plan that identifies key stakeholders, their information needs, and the most effective methods for reaching them. This plan should outline clear responsibilities for communication, establish protocols for escalating urgent information, and include mechanisms for feedback and evaluation. This aligns with regulatory expectations for robust risk management frameworks, which implicitly require effective communication to ensure that risks are understood and managed across the organization and with relevant external parties. Ethically, it demonstrates a commitment to transparency and responsible stewardship of client interests. Incorrect approach is analysis, an approach that relies solely on ad hoc, reactive communication when risks are identified, is professionally unacceptable. This failure stems from a lack of foresight and planning, leading to inconsistent messaging, potential for omissions, and an inability to effectively manage stakeholder expectations. Can result in regulatory scrutiny for inadequate risk oversight and communication. An approach that disseminates all identified risk information to all stakeholders simultaneously without tailoring the message or channel is also professionally flawed. This can lead to information overload, where critical details are lost, and can cause unnecessary alarm or confusion among those who do not require granular detail. This approach fails to meet the ethical obligation of clear and effective communication, potentially undermining trust. An approach that prioritizes internal communication of risks over external stakeholder communication, or vice versa, without a strategic rationale, is incomplete. Effective risk management requires a holistic view, and communication must be balanced to address the needs of all relevant parties, including clients, regulators, and internal teams. A skewed focus can lead to regulatory noncompliance and damage external relationships. Professional reasoning. Professionals should adopt a structured, risk-based approach to communication planning. This involves 1. Identifying all relevant stakeholders and their specific information requirements regarding risk. 2. Assessing the potential impact and urgency of different types of risks. 3. Designing communication channels and content that are appropriate for each stakeholder group. 4. Establishing clear roles and responsibilities for communication execution. And 5. Implementing a feedback loop to continuously improve the communication process. This systematic approach ensures that communication is not an afterthought but an integral component of the risk management process. Question 8. The audit findings indicate that the company's risk register contains a variety of identified risks, but the current risk assessment process appears to be treating all identified threats and opportunities with a uniform set of mitigation strategies, regardless of their inherent characteristics. Which of the following approaches to risk classification would best enable the company to develop more targeted and effective risk management strategies, aligning with a holistic approach to risk assessment? Option A. Assuming all industry-wide risks are fundamental and all company-specific risks are particular without further analysis. Option B. Categorizing all identified risks broadly as operational risks to streamline the assessment process. Option C. Focusing solely on the immediate financial impact of each risk without considering its underlying nature or origin. Option D. Differentiating risks based on whether they present only the possibility of loss, pure risk, versus the possibility of both gain and loss, speculative risk, and whether they are relatively constant over time, static risk, versus arising from change, dynamic risk, and whether they affect a broad segment of society or the economy, fundamental risk, versus affecting only specific entities, particular risk. The correct answer is D. Differentiating risks based on whether they present only the possibility of loss, pure risk, versus the possibility of both gain and loss, speculative risk, and whether they are relatively constant over time, static risk, versus arising from change, dynamic risk, and whether they affect a broad segment of society or the economy, fundamental risk versus affecting only specific entities, particular risk. Explanation. This scenario is professionally challenging because it requires the risk manager to accurately categorize identified risks based on their fundamental nature to ensure appropriate mitigation strategies are developed. Misclassifying a risk can lead to ineffective controls, wasted resources, or even significant financial or reputational damage. The audit findings highlight a need for precise risk identification and classification, which is a core component of holistic risk assessment. Correct approach involves distinguishing between pure and speculative risks, and between static and dynamic risks, and fundamental versus particular risks. Pure risks are those where there is only a possibility of loss or no loss, with no chance of gain. Speculative risks involve the possibility of gain as well as loss. Static risks are those that remain relatively constant over time, while dynamic risks are those that arise from changes in society, technology, or the economy. Fundamental risks affect a large segment of the population or economy, while particular risks affect only individuals or specific entities. Accurately categorizing risks according to these distinctions allows for the selection of the most suitable risk management techniques, such as avoidance, loss control, retention, or transfer. For example, pure risks are often managed through insurance, while speculative risks might be managed through hedging or strategic decision-making. Dynamic risks require continuous monitoring and adaptation, whereas static risks may allow for more stable control measures. Fundamental risks often necessitate broader societal or governmental responses, while particular risks can be managed at the organizational level. This precise classification is ethically mandated by the need to act with due care and diligence, ensuring that the organization's resources are allocated effectively to manage its risk exposure. An incorrect approach would be to broadly label all identified risks as simply operational risks without further differentiation. This fails to recognize the distinct characteristics of each risk type, such as whether they offer potential for gain, speculative, or only loss, pure, or if they are inherent to the business environment, static, or driven by external changes, dynamic. Ethically, this broad categorization is insufficient, as it does not demonstrate the required level of professional judgment and analytical rigor expected in risk management, can lead to the application of inappropriate mitigation strategies, potentially leaving the organization exposed to significant threats or missing opportunities. Another incorrect approach would be to focus solely on the immediate impact of a risk without considering its underlying nature. For instance, treating a risk that arises from a new competitor's market entry, dynamic, speculative, particular, the same way as a risk of fire in a warehouse, pure, static. Particular would be a failure. This approach neglects the crucial distinction between risks that are inherent to the business environment and those driven by external forces, or those that offer potential for gain versus those that only present a threat of loss. This lack of nuanced understanding is a regulatory failure, as it undermines the principle of comprehensive risk assessment and management. A third incorrect approach would be to assume that all risks affecting the entire industry are fundamental and therefore beyond the company's direct control, while risks affecting only the company are particular and manageable. This overlooks the possibility that a particular risk for one company might be a fundamental risk for a specific sector or niche market, or that a seemingly fundamental risk might have particular implications for the company that can be managed. This simplistic dichotomy fails to capture the interconnectedness of risks and the need for a granular analysis that considers both the breadth and depth of risk impact. It represents a failure to apply due diligence in understanding the full scope of risk exposure. The professional decision-making process for similar situations should involve a systematic approach. First, clearly define the risk event. Second, analyze the potential outcomes, distinguishing between loss-only scenarios, pure risk, and scenarios with potential for gain or loss, speculative risk. Third, assess the origin and stability of the risk, determining if it is relatively constant, static, or subject to change, dynamic. Fourth, evaluate the scope of impact, considering whether it affects a broad segment of the economy or population, fundamental, or is confined to the organization or specific entities, particular. Finally, based on this comprehensive classification, select and implement the most appropriate risk management strategies, ensuring alignment with regulatory expectations and ethical obligations for prudent risk oversight. Question 9. Investigation of the implementation of an enterprise risk management framework within a financial institution reveals several potential approaches. Which approach best aligns with the definition of and the holistic assessment of risk as typically expected under U.S. regulatory frameworks? Option A. Developing a comprehensive policy that mandates the integration of risk identification, assessment, and mitigation processes across all business units and risk categories, supported by a common risk taxonomy and reporting structure. Option B. Establishing a dedicated team that is solely responsible for identifying and assessing all risks, with the expectation that business units will report any identified risks to this team for management. Option C. Focusing on ensuring compliance with each specific risk-related regulation, e.g., credit risk, operational risk, cybersecurity risk, through dedicated departmental compliance officers, without a unified overarching risk management strategy. Option D. Implementing a new risk management software system that aggregates risk data from various departmental spreadsheets into a centralized database, with minimal changes to existing departmental risk management practices. The correct answer is A. Developing a comprehensive policy that mandates the integration of risk identification, assessment, and mitigation processes across all business units and risk categories, supported by a common risk taxonomy and reporting structure. Explanation. This scenario is professionally challenging because it requires an understanding of how to effectively implement enterprise risk management, within a specific regulatory context, moving beyond a theoretical definition to practical application. The core difficulty lies in balancing the comprehensive, integrated nature of with the practical constraints and specific requirements of the relevant regulatory framework, which in this case is assumed to be the U.S. regulatory framework for financial institutions, as implied by the ARM 401 exam context. Careful judgment is required to ensure that the implementation is not merely a compliance exercise, but a genuine enhancement of risk oversight. The correct approach involves establishing a clear, documented framework that integrates risk management activities across the organization, aligning with strategic objectives and regulatory expectations. This approach is right because it directly addresses the definition of as a holistic, integrated process. Regulatory guidance, such as that from the Federal Reserve or OCC, emphasizes the importance of a comprehensive program that identifies, assesses, manages, and monitors all material risks. This integrated approach ensures that risks are not managed in silos, leading to a more accurate understanding of the organization's overall risk profile and better informed decision-making, which is a fundamental tenet of effective risk management and a key expectation of regulators. An incorrect approach that focuses solely on departmental risk registers without cross-functional integration fails because it does not achieve the holistic nature of ERM. The siloed approach can lead to duplicated efforts, missed interdependencies between risks, and an incomplete view of the organization's risk landscape, which is contrary to the core principles of ERM and regulatory expectations for a unified risk management system. Another incorrect approach that prioritizes compliance with individual risk-specific regulations over an overarching ERM strategy is also professionally unacceptable. While adherence to specific regulations is crucial, an ERM framework is designed to provide a broader perspective. Focusing only on individual compliance without an integrated ERM program means the organization may meet minimum regulatory requirements for specific risks, but fail to identify or manage emerging or aggregate risks effectively, leaving potential blind spots. This fragmented approach undermines the strategic value of ERM. A third incorrect approach that treats ERM as a purely IT-driven initiative, relying solely on technology solutions without embedding risk management into business processes and culture, is flawed. While technology is an enabler, ERM is fundamentally a business discipline. Without active engagement from leadership and integration into daily operations, the ERM program will lack the necessary buy-in and effectiveness, failing to achieve its objective of embedding risk awareness and management throughout the organization. The professional decision-making process for similar situations should involve, first, thoroughly understanding the definition and objectives of ERM as a strategic and integrated process. Second, identifying the specific regulatory requirements and expectations applicable to the organization's jurisdiction. Third, evaluating proposed implementation strategies against both the ERM definition and regulatory mandates. Prioritizing approaches that foster integration, comprehensiveness, and alignment with strategic goals. Finally, ensuring that the chosen approach is practical, sustainable, and supported by organizational culture and leadership. Question 10. Strategic planning requires a thorough evaluation of potential initiatives. A company is considering implementing a new, more sophisticated risk management software system. The initial purchase and implementation costs are substantial, but the system promises to enhance the identification and mitigation of various operational and financial risks. Which of the following approaches to evaluating this initiative best aligns with the principles of holistic risk assessment and responsible strategic planning? Option A. Approve the initiative solely based on the projected reduction in immediate operational expenses, without a detailed assessment of the system's long-term risk mitigation capabilities or potential intangible benefits. Option B. Reject the initiative outright due to the high upfront implementation costs, focusing instead on leveraging existing, albeit less advanced, risk management tools to maintain current operational expenditure levels. Option C. Prioritize the initiative based on a detailed cost-benefit analysis that includes both quantifiable financial savings and qualitative benefits such as improved compliance and enhanced decision-making, alongside all associated implementation and ongoing costs. Option D. Proceed with the initiative if the projected cost savings from reduced manual oversight are significant, disregarding the system's potential to identify and prevent larger, less frequent risks. The correct answer is C. Prioritize the initiative based on a detailed cost-benefit analysis that includes both quantifiable financial savings and qualitative benefits such as improved compliance and enhanced decision-making, alongside all associated implementation and ongoing costs. Explanation: this scenario is professionally challenging because it requires balancing the immediate financial implications of implementing a new risk management system against its long-term benefits, all within the specific regulatory landscape of the Holistically Assessing Risk Exam, ARM 401, jurisdiction. The core of the challenge lies in the subjective nature of quantifying certain benefits and the potential for short-sighted decision-making driven by immediate cost pressures. Careful judgment is required to ensure that the chosen approach aligns with the regulatory mandate to holistically assess risk, which implies a forward-looking perspective that considers all relevant factors, not just immediate expenses. The correct approach involves a comprehensive cost-benefit analysis that quantifies both tangible and intangible benefits, such as improved regulatory compliance, reduced potential for fines, enhanced operational efficiency, and better stakeholder confidence, alongside the direct costs of implementation and ongoing maintenance. This approach is correct because it aligns with the principles of holistic risk assessment, which necessitates a thorough evaluation of all potential impacts, both positive and negative, of a proposed action. By considering a wide range of benefits, even those that are harder to quantify, the analysis provides a more complete picture of the value proposition, supporting a decision that is strategically sound and ethically responsible in its commitment to robust risk management. This aligns with the spirit of regulatory frameworks that encourage proactive risk mitigation and efficient resource allocation for long-term organizational health. An incorrect approach that focuses solely on easily quantifiable, short-term cost savings fails to meet the holistic assessment requirement. This approach is ethically flawed as it prioritizes immediate financial gains over potentially significant long-term risk reduction and operational improvements, which could ultimately lead to greater financial detriment if risks materialize. It also risks violating regulatory expectations by not fully considering the breadth of benefits associated with effective risk management systems. Another incorrect approach that overemphasizes the initial implementation cost without adequately considering the potential for future cost avoidance or revenue enhancement is also professionally unacceptable. This narrow focus can lead to underinvestment in critical risk management infrastructure, leaving the organization vulnerable to future losses that could far exceed the initial savings. This demonstrates a failure to apply a forward-looking, comprehensive risk assessment methodology. A third incorrect approach that relies on anecdotal evidence or incomplete data to justify the investment, rather than a structured cost-benefit analysis, is also problematic. This lacks the rigor expected in professional decision-making and can lead to decisions based on incomplete or biased information, potentially resulting in suboptimal outcomes and a failure to meet regulatory due diligence standards. The professional decision-making process for similar situations should involve 1. Clearly defining the scope of the analysis, including all relevant costs and benefits, both tangible and intangible. 2. Employing a structured methodology for quantifying benefits where possible, and for qualitatively assessing those that are difficult to quantify. 3. Engaging relevant stakeholders to gather diverse perspectives on potential impacts. 4. Benchmarking against industry best practices and regulatory expectations. 5. Documenting the entire process and the rationale for the final decision to ensure transparency and accountability. Question 11. Stakeholder feedback indicates a growing concern regarding the potential for operational disruption due to outdated IT infrastructure. The firm's risk management team is tasked with responding to this feedback. Which of the following approaches best aligns with a holistic risk management process for addressing this concern? Option A. Immediately allocate budget to upgrade the most critical IT systems identified by a few senior managers, without a comprehensive analysis of all potential vulnerabilities or their likelihood. Option B. Implement a new cybersecurity insurance policy to cover potential losses from IT disruptions, assuming this will adequately address the stakeholder concerns. Option C. Conduct a thorough risk assessment, starting with identifying all potential IT infrastructure vulnerabilities, analyzing their likelihood and potential impact, developing a range of control measures, considering financing options for residual risks, and establishing a monitoring plan. Option D. Focus on training IT staff to respond more quickly to system failures, as this is the most direct way to mitigate the perceived problem. The correct answer is A. Immediately allocate budget to upgrade the most critical IT systems identified by a few senior managers, without a comprehensive analysis of all potential vulnerabilities or their likelihood. Explanation. This scenario is professionally challenging because it requires balancing immediate stakeholder concerns with the long-term, systematic requirements of a robust risk management process. The pressure to address a visible issue quickly can lead to shortcuts that undermine the integrity of the entire risk framework. Careful judgment is required to ensure that the chosen approach is both responsive and compliant with regulatory expectations for a holistic risk assessment. The correct approach involves a structured, multi-stage risk management process that begins with identification and moves through analysis, control, financing, and monitoring. This aligns with the principles of a comprehensive risk management framework, which is implicitly or explicitly mandated by regulatory bodies overseeing financial services. by systematically identifying the root causes of the stakeholder concerns, analyzing their potential impact and likelihood, developing appropriate controls, considering financing mechanisms for residual risks, and establishing ongoing monitoring. The firm demonstrates a commitment to proactive and thorough risk management. This approach ensures that risks are not merely addressed superficially, but are understood and managed in a sustainable manner, fostering trust and regulatory compliance. An incorrect approach that focuses solely on immediate mitigation without proper identification and analysis fails to address the underlying systemic issues. This can lead to recurring problems and a perception of reactive, rather than proactive, risk management, which is often viewed unfavorably by regulators. Another incorrect approach that prioritizes cost-cutting over effective control measures, even if identified and analyzed, neglects the fundamental duty to protect stakeholders and maintain financial stability. This can result in inadequate risk mitigation, potentially leading to significant financial losses or reputational damage, and is a direct contravention of regulatory expectations for prudent risk management. A third incorrect approach that bypasses the analysis and control stages to jump directly to financing mechanisms without understanding the nature and scope of the risks is fundamentally flawed. Financing without proper understanding is speculative and does not constitute effective risk management. It can lead to misallocation of resources and an incomplete understanding of the firm's true risk exposure. Professionals should employ a decision-making framework that prioritizes adherence to the established risk management process. This involves 1. Acknowledging stakeholder feedback as a critical input for risk identification. 2. Ensuring that all identified risks undergo thorough analysis to understand their potential impact and likelihood. 3. Developing and implementing appropriate control measures based on the analysis. 4. Considering financing options for residual risks that cannot be eliminated. 5. Establishing robust monitoring mechanisms to track the effectiveness of controls and identify emerging risks. This systematic approach ensures that decisions are data-driven, compliant, and contribute to the overall resilience of the organization. Question 12. The review process indicates that the risk manager has primarily utilized historical incident reports to identify potential risks for the upcoming assessment. What is the most appropriate next step to ensure a holistically identified risk profile, adhering to regulatory expectations for comprehensive risk assessment? Option A. Request that all department heads independently conduct their own risk identification exercises using only their departmental knowledge and submit their findings. Option B. Supplement the analysis of historical incident reports with data from industry-wide risk surveys and conduct structured interviews with key personnel across different departments. Option C. Conclude that historical incident reports are sufficient as they represent actual past events and are therefore the most reliable indicators of future risk. Option D. Focus on refining the categorization and analysis of the existing historical incident reports to ensure a deeper understanding of past failures. The correct answer is B. Supplement the analysis of historical incident reports with data from industry-wide risk surveys and conduct structured interviews with key personnel across different departments. Explanation. The review process indicates a common challenge in risk management: the reliance on a single, potentially biased, risk identification technique. This scenario is professionally challenging because it requires the risk manager to critically evaluate the effectiveness and completeness of the chosen method, rather than simply accepting it at face value. The pressure to deliver a report quickly can lead to a superficial assessment, making it crucial to apply a discerning judgment based on regulatory expectations for thoroughness. The correct approach involves employing a combination of risk identification techniques. This is the best professional practice because it mitigates the inherent limitations of any single method. By using multiple techniques, such as internal incident reports, external industry data, and expert interviews, the risk manager can triangulate findings, uncover risks that might be missed by one method alone, and gain a more comprehensive understanding of the risk landscape. This aligns with regulatory expectations for a holistic and robust risk assessment, ensuring that all material risks are identified and considered. An incorrect approach would be to solely rely on historical loss data. This is professionally unacceptable because historical data, while valuable, is backward-looking and may not capture emerging risks or changes in the operating environment. Regulatory frameworks often emphasize forward-looking risk assessment, and an exclusive reliance on past events could lead to a failure to identify and prepare for future threats. Another incorrect approach is to exclusively use a single qualitative survey administered to a small group of senior managers. This is professionally unacceptable because it limits the scope of input and can be subject to individual biases or a lack of awareness of risks at different operational levels. Regulatory guidance typically requires a broader engagement to ensure a comprehensive view of risks across the organization. Finally, an incorrect approach would be to only consider risks that have been explicitly documented in previous risk registers. This is professionally unacceptable as it stifles proactive risk identification and assumes that all significant risks have already been captured. Regulatory expectations demand a dynamic and ongoing process of risk identification, not a static review of past documentation. Professionals should employ a decision-making framework that prioritizes a multifaceted approach to risk identification. This involves understanding the strengths and weaknesses of various techniques, considering the specific context of the organization and its operating environment, and ensuring that the chosen methods are aligned with regulatory requirements for comprehensiveness and foresight. A critical self-assessment of the chosen techniques and a willingness to adapt and supplement them are key to effective risk management. Question 13. Benchmark analysis indicates that a new, complex regulatory requirement has been introduced that could significantly affect the organization's ability to achieve its long-term strategic objectives. To holistically assess the potential impact of this regulation, which component of an framework is most critical to leverage for this initial impact assessment? Option A, the component responsible for selecting and implementing risk responses. Option B, the component focused on ongoing monitoring of risk management activities. Option C, the component focused on establishing and communicating risk appetite and aligning it with strategy. Option D, the component dedicated to identifying potential risks and threats to the organization. The correct answer is C, the component focused on establishing and communicating risk appetite and aligning it with strategy. Explanation: this scenario is professionally challenging because it requires the risk manager to select the most appropriate framework component for assessing the impact of a new regulatory requirement on the organization's strategic objectives. The difficulty lies in understanding the nuances of each framework's application and how they align with the specific task of impact assessment, especially when considering the holistic nature of enterprise risk management. Careful judgment is required to ensure the chosen approach not only addresses the immediate need, but also contributes to a robust and integrated system. The correct approach involves focusing on the risk appetite and strategy component of the COSO framework. This component is designed to ensure that the organization's risk-taking aligns with its strategy and business objectives. Assessing the impact of a new regulation on strategic objectives directly falls under this purview, as it necessitates understanding how the regulation might hinder or alter the pursuit of those objectives, and whether the organization's current risk appetite can accommodate the new compliance risks. This aligns with the core principles of which emphasize the integration of risk management with strategy setting and performance. An incorrect approach would be to focus solely on the risk identification component of the COSO framework. While identifying the new regulation as a risk is a necessary first step, this component alone is insufficient for assessing its impact on strategic objectives. It stops short of evaluating the magnitude or consequence of the risk, which is crucial for understanding its strategic implications. Another incorrect approach would be to focus on the risk response component of the COSO framework. This component deals with selecting and implementing actions to manage identified risks. While a response will eventually be needed, assessing the impact on strategic objectives must precede the selection of a response. Acting without a clear understanding of the impact could lead to ineffective or misaligned risk mitigation strategies. Finally, an incorrect approach would be to focus on the monitoring activities component of the COSO framework. Monitoring is essential for ongoing oversight, but it is a post-implementation activity. The immediate need is to understand the potential impact of the regulation on the organization's strategic direction, which requires a forward-looking assessment rather than a review of ongoing processes. The professional decision-making process for similar situations involves first clearly defining the objective of the assessment impact on strategic objectives. Then, the risk manager should review the available frameworks and their respective components, considering which component most directly addresses the defined objective. This involves understanding the purpose and scope of each component within the broader framework. Finally, the manager should select the component that provides the most comprehensive and relevant guidance for the specific task, ensuring alignment with the holistic principles of Question 14. Assessment of a risk management team's utilization of a heat map to visually represent identified risks, considering the principles of holistic risk assessment as mandated by the Holistically Assessing Risk Exam, ARM 401 framework, leads to the following scenario. The team has generated a heat map that clearly displays a high concentration of risks in the medium likelihood, medium impact quadrant. They are now debating the next steps. Which of the following approaches best aligns with the regulatory framework and best practices for a holistic risk assessment? Option A. The team should prioritize addressing the risks in the high likelihood, high impact quadrant, even if there are fewer risks plotted there, as these represent the most critical threats to the organization. Option B. The team should focus on developing detailed mitigation plans for all risks plotted in the medium likelihood, medium impact quadrant, as this quadrant represents the most significant area of concern based on the visual representation. Option C. The team should immediately reevaluate the likelihood and impact scoring for all risks in the medium likelihood, medium impact quadrant to ensure accuracy, as the sheer number of risks in this area suggests a potential flaw in the initial assessment. Option D. The team should use the heat map primarily as a communication tool to present the risk landscape to senior management, without necessarily dictating specific actions based solely on the visual density of risks. The correct answer is B. The team should focus on developing detailed mitigation plans for all risks plotted in the medium likelihood, medium impact quadrant, as this quadrant represents the most significant area of concern based on the visual representation. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how risk mapping, specifically heat maps, should be utilized within the context of the Holistically Assessing Risk Exam, ARM 401 framework. The core of the challenge lies in correctly interpreting the purpose and limitations of heat maps as a risk assessment tool, ensuring they contribute to a holistic view rather than becoming a superficial exercise. Professionals must demonstrate the ability to apply regulatory principles to practical risk management techniques, avoiding common pitfalls that could lead to misinformed decision-making or regulatory noncompliance. The correct approach involves using the heat map as a dynamic tool to identify and prioritize risks based on their likelihood and impact, facilitating a more informed discussion about resource allocation and mitigation strategies. This aligns with the ARM 401 emphasis on a holistic assessment by ensuring that the visual representation of risk directly informs strategic decisions and supports the development of comprehensive risk management plans. Regulatory and ethical justification stems from the principle of due diligence and prudent risk management, which mandates that identified risks are adequately understood and addressed. A heat map, when used correctly, serves as a critical component in demonstrating this due diligence by providing a clear, albeit simplified, overview of the risk landscape. An incorrect approach that focuses solely on the visual appeal or the number of risks plotted on the heat map fails to meet the regulatory expectation of a thorough risk assessment. This approach is ethically problematic as it prioritizes presentation over substance, potentially masking underlying significant risks or overemphasizing minor ones. Another incorrect approach that treats the heat map as a static, one-time deliverable neglects the dynamic nature of risk. This is a regulatory failure because it implies a lack of ongoing risk monitoring and review, which is fundamental to effective risk management. Furthermore, an approach that uses the heat map to justify inaction on certain risks without a clear, documented rationale based on impact and likelihood assessment demonstrates a failure to adhere to principles of sound risk governance and could be seen as a breach of professional responsibility. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements and objectives of the ARM 401 exam. This involves recognizing that risk assessment tools like heat maps are means to an end, a holistic understanding and management of risk. The process should involve clearly defining the criteria for likelihood and impact, populating the heat map with data derived from thorough analysis, and critically interpreting the results to inform strategic decisions. This interpretation should be documented and justifiable, ensuring transparency and accountability. Professionals must continuously question the output of such tools, ensuring they align with the broader organizational risk appetite and strategic goals, rather than accepting them at face value. Question 15. Upon reviewing the firm's current operational resilience framework, a significant cost-saving initiative has been proposed to reduce expenditure on maintaining multiple suppliers for critical raw materials and to decrease buffer stock levels. The head of procurement argues that consolidating suppliers and reducing inventory will yield substantial immediate financial benefits. However, the head of risk management is concerned that this could expose the firm to greater disruption risk if a single supplier fails or if demand unexpectedly surges. Considering the firm's regulatory obligations for operational resilience, which of the following approaches best addresses this situation? Option A. Delegate the decision-making for supplier consolidation and inventory levels to individual operational departments, allowing them to implement changes based on their immediate departmental needs and cost-saving targets. Option B. Conduct a comprehensive scenario analysis to identify potential failure points in a consolidated supply chain, quantify the potential impact of disruptions, and develop specific contingency plans, including alternative sourcing strategies and dynamic inventory management protocols, before approving any changes. Option C. Implement the supplier consolidation and inventory reduction immediately, relying on the historical reliability of the proposed single supplier and the assumption that demand fluctuations are unlikely to be severe. Option D. Approve the cost-saving initiative immediately to realize the financial benefits, with a commitment to address any supply chain issues that may arise on an ad hoc basis as they occur. The correct answer is B. Conduct a comprehensive scenario analysis to identify potential failure points in a consolidated supply chain, quantify the potential impact of disruptions, and develop specific contingency plans, including alternative sourcing strategies and dynamic inventory management protocols, before approving any changes. Explanation. This scenario is professionally challenging because it requires balancing immediate cost-saving pressures with long-term operational resilience, a core tenet of holistic risk assessment. The pressure to reduce expenses can lead to overlooking critical vulnerabilities in the supply chain, which, if disrupted, could have significant financial and reputational consequences. Careful judgment is required to identify and mitigate these risks effectively, without unduly hindering business operations or profitability. The correct approach involves a proactive and comprehensive assessment of supply chain dependencies and potential failure points, coupled with the development of robust contingency plans. This aligns with regulatory expectations for firms to maintain operational resilience, ensuring they can continue to provide services and protect client assets even in the face of disruptions. Specifically, it reflects the principles of identifying critical dependencies, assessing their susceptibility to various risks, e.g., geopolitical instability, natural disasters, cyber threats, and establishing mitigation strategies such as diversification of suppliers, maintaining adequate inventory levels, and developing clear communication protocols with key partners. This proactive stance is ethically sound as it prioritizes the firm's ability to meet its obligations to clients and stakeholders. An incorrect approach that focuses solely on immediate cost reduction without considering the resilience implications fails to meet regulatory standards for operational resilience. Such an approach would likely overlook the potential for cascading failures within the supply chain, leaving the firm exposed to significant operational and financial risks. This demonstrates a failure to holistically assess risk, as it prioritizes short-term financial gains over long-term stability and the firm's ability to function under adverse conditions. Another incorrect approach that relies on anecdotal evidence or past experience without systematic analysis is also professionally unacceptable. Regulatory frameworks emphasize data-driven decision-making and robust risk assessment methodologies. Relying on assumptions or past performance without current, thorough due diligence can lead to a false sense of security and leave critical vulnerabilities unaddressed. This represents a failure in professional due diligence and a disregard for the principles of sound risk management. Finally, an approach that delegates resilience planning entirely to individual departments without central oversight or a unified strategy is flawed. Effective supply chain resilience requires a coordinated effort across the organization, with clear lines of responsibility and accountability. Without this, efforts may be fragmented, inconsistent, and ultimately ineffective in building a truly resilient supply chain. This demonstrates a lack of strategic thinking and a failure to embed resilience as an organizational priority. Professionals should employ a decision-making framework that begins with understanding the firm's critical functions and the supply chain dependencies that support them. This should be followed by a systematic risk assessment of these dependencies, considering a wide range of potential disruptions. Mitigation strategies should then be developed and implemented, with regular review and testing of their effectiveness. This process should be integrated into the firm's overall risk management framework and overseen at a senior level to ensure alignment with business objectives and regulatory requirements. Question 16. The assessment process reveals a complex emerging risk scenario for which historical data is scarce, necessitating significant reliance on the insights of experienced underwriters. Which approach best aligns with the regulatory framework for a holistic risk assessment? Option A. Disregard expert judgment due to the lack of quantitative data and focus solely on extrapolating trends from limited historical information. Option B. Systematically gather and document the individual judgments of multiple experienced underwriters, cross-referencing their rationale with any available qualitative indicators, and clearly noting any assumptions made. Option C. Prioritize the consensus view of the most senior underwriters, assuming their experience inherently accounts for all relevant factors. Option D. Exclusively rely on the opinion of the single underwriter with the longest tenure in the department, as their experience is considered unparalleled. Correct answer is C. Prioritize the consensus view of the most senior underwriters, assuming their experience inherently accounts for all relevant factors. Explanation. This scenario presents a professional challenge because it requires the ARM 401 professional to balance the need for timely risk assessment with the inherent subjectivity and potential biases associated with expert judgment. The core difficulty lies in ensuring that expert opinions, while valuable, are not unduly influential or based on incomplete information, and that they are integrated into the holistic risk assessment in a defensible and compliant manner. Regulatory frameworks, such as those governing financial services or insurance, often mandate robust risk assessment processes that are both comprehensive and objective. The correct approach involves systematically documenting the basis for expert judgment, cross-referencing it with available data, and clearly articulating any assumptions made. This ensures transparency and allows for subsequent review and validation. Regulatory compliance is achieved by adhering to principles of sound risk management, which emphasize evidence-based decision-making and the avoidance of arbitrary or unsupported conclusions. Ethical considerations also dictate that expert opinions should be sought and used in a manner that promotes fairness and accuracy, without introducing undue bias. An incorrect approach would be to solely rely on the most senior expert's opinion, without seeking corroboration or challenging underlying assumptions. This fails to meet the holistic assessment requirement and could lead to a skewed risk profile based on a single, potentially flawed perspective. Regulatory failure occurs because it bypasses the due diligence expected in a comprehensive risk assessment. Another incorrect approach is to dismiss expert judgment entirely in favor of purely quantitative data, even when the data is insufficient to capture qualitative risks. This ignores a crucial source of insight and can lead to an incomplete understanding of the risk landscape, violating the spirit of holistic assessment. Ethically, this could be seen as a failure to leverage all available relevant information. The professional decision-making process should involve 1. Identifying the specific risk area requiring expert input. 2. Selecting experts with relevant and demonstrable knowledge. 3. Clearly defining the scope and objectives of their input. 4. Systematically gathering and documenting their judgments, including the rationale and any supporting evidence or assumptions. 5. Critically evaluating expert opinions against other available data and internal risk models. 6. Integrating validated expert insights into the overall risk assessment in a transparent and justifiable manner. Question 17. Performance analysis shows that the company's supply chain has experienced several minor disruptions over the past year, leading to short-term delays but no significant financial losses. Management is now considering a new initiative to streamline operations by consolidating suppliers and reducing inventory levels to improve cost efficiency. As a risk management professional, which approach to developing a contingency plan for potential supply chain disruptions best aligns with a holistic risk assessment framework and stakeholder interests. Option A. Develop a contingency plan that addresses only the types of minor disruptions that have occurred previously, without considering broader potential risks. Option B. Delegate the entire responsibility for developing the contingency plan to an external consulting firm, relying on their general expertise in supply chain management. Option C. Focus solely on implementing the cost-saving initiative by consolidating suppliers and reducing inventory, assuming that minor past disruptions indicate low overall risk. Option D. Proactively engage key internal and external stakeholders to identify critical supply chain dependencies and potential vulnerabilities, then prioritize risks and develop tailored mitigation and response strategies. Correct answer is D. Proactively engage key internal and external stakeholders to identify critical supply chain dependencies and potential vulnerabilities, then prioritize risks and develop tailored mitigation and response strategies. Explanation: this scenario is professionally challenging because it requires balancing the immediate need for operational continuity with the long-term strategic imperative of robust risk management, all within the specific regulatory confines of the Holistically Assessing Risk exam, ARM 401. The core difficulty lies in identifying and prioritizing stakeholder concerns related to supply chain disruptions, ensuring that the contingency plan addresses the most critical risks without becoming overly burdensome or impractical. Careful judgment is required to differentiate between potential disruptions and probable, high-impact events. The correct approach involves proactively engaging with key internal and external stakeholders to identify critical supply chain dependencies and potential vulnerabilities. This collaborative process allows for comprehensive understanding of the potential impact of various disruptions on different business functions and customer segments. By prioritizing risks based on their likelihood and potential severity, and then developing tailored mitigation and response strategies, the organization can build a resilient supply chain. This aligns with the principles of holistic risk assessment, which emphasizes understanding interdependencies and potential cascading effects. Regulatory frameworks, including those implicitly tested in ARM 401, often mandate or encourage such proactive risk management and stakeholder engagement to ensure business continuity and protect customer interests. Ethical considerations also support this approach, as it demonstrates a commitment to fulfilling contractual obligations and maintaining customer trust during adverse events. An incorrect approach that focuses solely on cost reduction without adequately assessing the risk implications of supply chain changes would be professionally unacceptable. This failure stems from a narrow, short-sighted perspective that neglects the potential for significant financial and reputational damage if critical supplies are interrupted. Such an approach would likely violate the spirit, if not the letter, of risk management regulations that require a comprehensive evaluation of all material risks. Another incorrect approach that prioritizes only the most visible or recent disruptions, without a systematic analysis of the entire supply chain, would also be flawed. This reactive strategy fails to identify less obvious but potentially catastrophic vulnerabilities. It neglects the holistic nature of risk assessment, which requires looking beyond immediate threats to understand systemic weaknesses. This can lead to inadequate preparedness for a wide range of potential disruptions, leaving the organization exposed. A further incorrect approach that relies solely on external consultants to develop the contingency plan without significant internal input would be problematic. While consultants can offer valuable expertise, a lack of internal buy-in and understanding can lead to a plan that is difficult to implement or maintain. This approach risks creating a theoretical plan that does not reflect the practical realities of the organization's operations and stakeholder relationships, potentially failing to meet regulatory expectations for effective risk management. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying all relevant stakeholders and understanding their perspectives and concerns regarding supply chain resilience. Next, a thorough risk identification process should be undertaken, considering a wide range of potential disruptions. This should be followed by a risk analysis and evaluation phase, where the likelihood and impact of identified risks are assessed. Based on this evaluation, appropriate risk treatment strategies, including contingency planning, should be developed and implemented. Finally, ongoing monitoring and review are essential to ensure the effectiveness of the contingency plan and to adapt to changing circumstances. Question 18. Implementation of a new investment product with a higher commission structure presents a scenario where an advisor must decide how to present this to a long-standing client who has expressed concerns about market volatility. The advisor knows this product offers greater potential returns, but also carries increased risk, which the client has indicated they are uncomfortable with. The advisor also has a personal incentive to meet higher sales targets for the quarter. What is the most ethically sound approach for the advisor? Option A. Suggest the new product as a way to diversify the client's portfolio without fully detailing the increased risk, as the client has expressed general concerns about market volatility and might be persuaded by the diversification aspect. Option B. Conduct a thorough review of the client's current financial situation, risk tolerance, and stated objectives, and then recommend the new product only if it demonstrably aligns with these factors and regulatory suitability requirements, clearly explaining all associated risks and benefits. Option C. Emphasize the potential for higher returns of the new product to the client, downplaying the increased risk to encourage them to invest, as meeting sales targets is important for the firm's performance. Option D. Decline to discuss the new product with this client, as their stated discomfort with volatility makes them an unsuitable candidate, and focus on selling other, lower commission products that better fit their risk profile. The correct answer is B. Conduct a thorough review of the client's current financial situation, risk tolerance, and stated objectives, and then recommend the new product only if it demonstrably aligns with these factors and regulatory suitability requirements, clearly explaining all associated risks and benefits. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial needs with the long-term ethical obligation to provide suitable advice. The advisor must navigate potential conflicts of interest and ensure that recommendations are not driven by personal gain or pressure, but solely by the client's best interests and regulatory requirements. Careful judgment is essential to avoid misrepresentation and maintain client trust. Correct approach involves a thorough assessment of the client's financial situation, risk tolerance, and objectives, followed by a recommendation that aligns with these factors and adheres to regulatory standards for suitability. This approach prioritizes the client's welfare and upholds the advisor's fiduciary duty, ensuring that advice is objective and in the client's best interest, as mandated by ethical codes and regulatory frameworks governing financial advice. An incorrect approach that prioritizes the immediate sale of a high-commission product without a comprehensive needs analysis fails to meet the client's actual requirements and potentially exposes them to undue risk. This violates the ethical principle of acting in the client's best interest and could contravene regulations requiring suitability of advice. Another incorrect approach that involves downplaying the risks associated with a product to secure a sale misrepresents the investment's characteristics. This is ethically unsound and a direct violation of regulations prohibiting misleading statements and requiring full disclosure of material information. A further incorrect approach that focuses solely on meeting sales targets, irrespective of the client's circumstances, demonstrates a disregard for professional responsibility. This prioritizes the advisor's or firm's objectives over the client's welfare, leading to potential harm to the client and breaches of ethical and regulatory obligations. Professionals should employ a structured decision-making process that begins with identifying the ethical dilemma, gathering all relevant client information, considering applicable regulations and ethical codes, evaluating potential courses of action against these standards, and finally, selecting the option that best serves the client's interests while maintaining professional integrity. This process ensures that decisions are well-reasoned, justifiable, and compliant. Question 19. Which approach would be most appropriate for an underwriter to adopt when analyzing historical loss data to holistically assess the risk of a commercial property insurance policy, considering the need to look beyond simple statistical extrapolation? Option A. A focus exclusively on the average loss cost per policy, without investigating the volatility or distribution of those losses. Option B. Qualitative overlay that considers the underlying causes of past losses, the effectiveness of current controls, and the potential impact of emerging risks in conjunction with quantitative analysis of historical data. Option C, a sole reliance on the most recent 5 years of loss data, assuming that recent trends are the most accurate predictors of future losses. Option D, an arbitrary dismissal of any loss data older than 2 years, deeming it irrelevant for current risk assessment. The correct answer is B, a qualitative overlay that considers the underlying causes of past losses, the effectiveness of current controls, and the potential impact of emerging risks in conjunction with quantitative analysis of historical data. Explanation: this scenario is professionally challenging because it requires an underwriter to move beyond simple statistical analysis of historical loss data to a more nuanced, forward-looking assessment of future risk. The challenge lies in interpreting the data in the context of evolving business operations, market conditions, and potential systemic risks, which are not always directly reflected in past claims. Careful judgment is required to avoid over-reliance on historical trends that may no longer be predictive. The correct approach involves a qualitative overlay to quantitative loss data analysis. This means not just looking at the frequency and severity of past claims, but also considering the underlying causes, the effectiveness of existing controls, and the potential impact of emerging risks. This aligns with the principles of holistic risk assessment, which mandates a comprehensive view that integrates historical data with forward-looking analysis. Regulatory frameworks, such as those guiding the Holistically Assessing Risk exam, ARM 401, emphasize the need to understand the drivers of risk and to make informed judgments about future potential losses, rather than simply extrapolating past patterns. Ethical considerations also demand that underwriters act with due diligence and competence, which includes employing robust analytical methods that account for dynamic risk environments. An incorrect approach would be to solely rely on the most recent 5 years of loss data, without considering any contextual factors. This fails to acknowledge that past performance is not always indicative of future results, especially in a dynamic business environment. It also neglects the potential for significant changes in operational procedures, market dynamics, or the introduction of new technologies that could materially alter the risk profile. This approach risks underestimating or overestimating future losses due to a lack of comprehensive understanding. Another incorrect approach would be to focus exclusively on the average loss cost per policy without investigating the volatility or distribution of those losses. This can lead to a distorted view of risk, as it smooths out extreme events that could have a significant impact. A holistic assessment requires understanding the full spectrum of potential losses, including the possibility of catastrophic events, not just the average. This approach fails to meet the requirement of thoroughly understanding the risk landscape. A third incorrect approach would be to dismiss any loss data older than 2 years as irrelevant, regardless of its nature or the stability of the underlying operations. While older data may be less predictive, certain types of losses or systemic issues might have longer lead times or recurring patterns that are still relevant. This arbitrary cutoff ignores the potential for long-term trends or the impact of historical events on current risk exposure, thus failing to provide a truly holistic assessment. The professional decision-making process for similar situations should involve a structured approach. First, gather and analyze historical loss data quantitatively. Second, critically evaluate the context surrounding that data, considering operational changes, market trends, and emerging risks. Third, integrate qualitative insights with quantitative findings to form a forward-looking risk assessment. Finally, document the rationale for the assessment, clearly articulating the assumptions and judgments made. Question 20. The analysis reveals that an insurance underwriter is tasked with modeling the potential severity of large property damage claims. Historical data indicates that, while most claims are of moderate value, there is a significant possibility of a few extremely high-value claims that could disproportionately impact the overall loss experience. The underwriter needs to select the most appropriate probability distribution to represent this risk for capital adequacy calculations, without performing complex mathematical computations. Option A, log-normal distribution. Option B, beta distribution. Option C, normal distribution. Option D, triangular distribution. The correct answer is A, log-normal distribution. Explanation: scenario analysis. This scenario presents a professional challenge because it requires an insurance underwriter to select the most appropriate probability distribution to model a specific risk, not based on mathematical calculation, but on the qualitative characteristics of the risk and the available data. The challenge lies in understanding the underlying assumptions and typical applications of different distributions, and aligning them with the real-world risk being assessed, while adhering to regulatory expectations for sound risk management. Misinterpreting the nature of the risk or the suitability of a distribution can lead to inaccurate pricing, inadequate reserving, and ultimately, regulatory noncompliance and financial instability for the insurer. Correct approach analysis. The correct approach involves selecting the log-normal distribution because the described risk, insurance claim severity, is inherently non-negative and often exhibits a skewed distribution, where a few large claims can significantly impact the overall severity. The log-normal distribution is well suited for modeling such data, as it assumes that the logarithm of the variable is normally distributed, allowing for a skewed but positive distribution. This aligns with the principle of accurately reflecting the potential for extreme events in risk assessment, a key component of holistic risk assessment expected under regulatory frameworks that emphasize prudent management of financial risks. Incorrect approaches analysis. Choosing the normal distribution would be an incorrect approach because it assumes symmetry and a bell-shaped curve, which is generally not representative of insurance claim severities. Claims cannot be negative, and the presence of a few very large claims would violate the symmetry assumption, leading to an underestimation of potential losses. This failure to accurately model the risk's characteristics would be a regulatory concern, as it demonstrates a lack of due diligence in risk assessment. Selecting the triangular distribution, while capable of modeling skewed data, is often used when there is limited historical data and expert judgment is heavily relied upon to define minimum, most likely, and maximum values. In this scenario, where historical data is available and the nature of claim severity is better understood, relying solely on a triangular distribution might oversimplify the underlying process and not capture the nuances of potential extreme events as effectively as the log-normal. This could be seen as a less robust approach to risk modeling. Opting for the beta distribution would also be incorrect. The beta distribution is typically used to model probabilities or proportions, which are bounded between 0 and 1. Insurance claim severity is a monetary value and is not inherently bounded in this way, making the beta distribution inappropriate for this specific risk characteristic. Using a distribution that is fundamentally unsuited to the nature of the variable being modeled represents a significant failure in applying appropriate risk assessment tools. Professional reasoning. Professionals should approach such decisions by first thoroughly understanding the nature of the risk being modeled. This involves considering its inherent characteristics, such as whether it can be negative, its potential range, and its typical shape, symmetric or skewed. Next, they should evaluate the available data and its quality. Finally, they must match these characteristics with the theoretical assumptions and typical applications of various probability distributions. Regulatory guidance often emphasizes the need for models to be fit for purpose and to accurately reflect the underlying risks. When in doubt, consulting with actuarial or risk management specialists and documenting the rationale for the chosen distribution is crucial for demonstrating professional judgment and regulatory compliance.